Hi, welcome to series 3 of 3, Candlestick Patterns, the Engulfing Bar. Alright, so if you have followed me for the candlestick story and the battle between the bulls and the bears, the buyers and the sellers, you will understand again how an engulfing bars come about. Let me explain. So what does an engulfing bar means? Very simply, it means one bar engulfs the other or eats the other up. So this is the price action story that we are looking at. All right, so basically if you look at bar A over here, what happened in the day was price open at the top over here. Buyers and sellers are fighting for the ball. In the end, the sellers won for this particular day, and the bar closes at the bottom over here, forming a red bar. Now we look at the next day when the buyers wake up and see, hey, price is being pushed down, but we want to show who is in control. So price opened over here. The buyers come into the market and push the price all the way back up, overpowering the sellers. Not only does it overpower the sellers, it overpowers the sellers so much that price actually went higher than yesterday's price. All right, so this bar, you can see it even went higher than yesterday's high price, showing how strong the buyers are on this second day at bar B. All right, so in that sense, the buying momentum, the buying strength of the second day is bigger than the first day, than the selling strength of the first day, and it engulfs or eats the previous bar. So this is the reason why the body of this bar has to be bigger than this entire candle, basically eating the entire candle up. Looking at the similar example, except in terms of bearish downtrend or a downwards direction, we have one day on day A is where price opens, went up, okay, and closes on the day, and the seller and the buyers are in control on day one, right? Next day, where the sellers wake up and they see the price, they're not happy with it. They say, hey, price has gone up so much, let's push it back down. They want to be in control. A lot of sellers see that it's a really great price to sell it. So they come in over here and they push the price all the way down, not just by a little bit, but by so much that the closing price at the end of the day overpowers or eats the bar on the previous day. So this is why it's called engulfing, where bar B eats bar A, and price on the second day basically overpowers and consumes the previous bar. So in this sense, it shows that there is something happened at this area. Something is changing. The upward pattern you see over here is no longer in continuation. So if you look at candlesticks, don't just look at the two bars, but look at the series of bars, right? So you have to look at what's been happening before bar A. It means that price is going on Monday, price open here, close here, has been going up. Tuesday, price open and it's still going up. Wednesday, price is still going up. But on Thursday, the sellers come in and say, hey, that's enough. And what they do is they push price all the way back down and really engulfs it. So this engulfing bar, it is called, often used as a reversal pattern, because price is no longer going up. Sellers have come in and changed the direction of the price direction, and hence a reversal has formed. So in an example, when we are looking at charts, this is how you might see price behave. All right, so what has happened on this day really simply is, if you look at price patterns from here onwards, all right, let's just say price has been going up. You can see the cyclicity, the higher high, higher low. You can see that price is moving in an upwards direction. It's moved upward and even overshot a support and resistance level over here. So what often happens is, again, you see this looks like a high test bar, right? That's happening. So price has actually started to reverse over here already. And over here, you can see an engulfing bar happens. Okay, so in a way of telling a story, it's just very simply the buyers are in control over here, really, really strong, and suddenly the sellers pop in and say, hey, that's enough. Let's win this game, and they push price all the way back down. But once it hits a certain support and resistance levels, oftentimes the buyers will come in again, because again, support and resistance levels form is because it is a price perceived by a lot of people that is either cheap or expensive or good for profit taking. Hence, a lot of players come into the market to try to figure it out. And you can see that a lot of price action or fighting for position is happening. And then finally, you'll see this engulfing bar pattern happens, which means that something is going to happen here. So the buyers and sellers are basically fighting for this couple of days. And then suddenly, the sellers go, hey, you know, let's just show you how strong we are. Let's take control of the game, take control of the ball, and they sell so hard that the closing price actually closed below the previous bar and eats the other bar, just to show how strong they are. And you know, it on top of that, it happens on a resistance level. So it's a way of saying the upward price is no longer valid, you know, and this reversal price action has happened and price just waterfalls after that. So this is an example of how an engulfing bar looks like. And when we are trading it on our strategies, for example, the reason why we look for price action candles like the engulfing bar on our pivots, you know, it's just to show, it's just to find out who is in control and whether or not there is a potential for price to reverse its previous position. So hope this clarifies on engulfing bar. Thank you very much.